Great. So thank you very much, Clemens, for the very kind introduction. Thank you very much for inviting me to this workshop. It's great actually to see so many interesting papers looking through the schedule for the next 2 days. Actually, some of the papers also relating to what I'd like to discuss and I'd like to talk about, which is I would say, one of the key questions currently facing Europe or European policymakers in the question of what happens actually between banks and states, and what are the risks that states create that affect banks, and the risks that banks create that affect states. So therefore, as I saw, I think that even the first paper just following my contribution deals with a similar question, and the question of what really is going on. And so basically what I'd like to do is to first describe a little bit the challenge. So where do we stand? What are the current questions that we need to face? And then to present a suggestion, a policy suggestion that I've worked on with a co-author on how to tackle this question. So in that sense, you see here the rough outline of my talk, which is first to introduce the question itself, thinking about why do we need to care about it, what are current suggestions out there, and also to, as I said, to discuss the suggestion of the so-called Eurozone basket, which my co-author and myself have developed. So now, first, the big question, what really is at stake? At stake is what is referred to as the sovereign bank nexus or state bank nexus. And this is referred to as the question or the challenge that whenever we see risks on the banking side, they may affect the sovereign, or vice versa, when we see risks on the sovereign side, that they may affect the banks. How can this work? So for example, we all know the cases, say, of Spain and Ireland. In those cases, sovereign debt levels were actually pretty low. They were not very high in those years preceding the financial crisis. Rather, it was the case that, for example, Spain had financial surpluses, budget surpluses between 2005 and 2007. But at the same time, the banking sector got into trouble. The real estate sector was booming. There was then, you could say, an overly excessive speculation in the real estate sector, which finally led to the fact that there was an overwhelmingly large amount of bad loans affecting the banks, and finally also the state had to step in to stabilize those banks, bringing the state government or the debt level of Spain or Ireland to a very high level in a very short period of time. Something that actually rating agencies in a certain sense have already predicted. They say it's very easy, rather easy, to figure out ratings for corporate bonds. You more or less only need two variables. The one is the leverage ratio, so how much debt and equity does a company have. So this means the more leverage, the more likely the corporate bond is going to default. And the second one is the so-called coverage ratio. So this means how much free cash flow do you have in a given year vis-a-vis how much needs to be served in interest payments. Having those two components is rather very straightforward to value and to rate corporate bonds. It's not the case for sovereign bonds. Rating agencies even admit that they more or less don't know much about how to do proper ratings of sovereign bonds, just because they argue it is very, let's say it's even somehow clear how you can figure out the financial situation of the government itself. But what is never quite clear is how the private sector may affect the situation of the government. So this means in those cases of Spain and Ireland, those massive challenges in the private sector then it also had an effect on the public sector. So that's the one way of the direction. The other one, and this is the one that I feel is more challenging at this point of time, given that it has not been really addressed, you may even argue it has become even more severe, is the question of what is happening if states get into trouble and then the banks that hold the government bonds of those states may be affected as well. The classical example is Greece. So when you look at Greece and the haircut that took place in March 2012, what you can observe is that Greek banks held on average, say, 4 times the equity in Greek government bonds. So there was no limit, and there still is no limit in how much banks can hold of government debt of a given country or even overall. So this is completely at odds with what we can observe with any other borrower. So a bank normally, which makes sense, you never should put all your eggs into one basket. a bank is not allowed to give more than 25% of its equity to one borrower. This holds for all the borrowers except for one, which are all the public institutions. So this means local governments, but also states. And in Greece, this resulted in the fact that, as I said, Greek banks held 4 times the equity on average in Greek government bonds. This also means if at a given point of time, as in the case of Greece, there's a haircut of government debt of, say, 50%, all the banks, without any help, would be bankrupt right away. And therefore, if indeed a haircut is needed, if a haircut is undertaken, one immediately needs to think about what actually needs to be done to recapitalize those banks to actually keep them alive. To give you some examples to also show the economic magnitude of that. When looking at Greece at this haircut in 2007, one can say the different programs together, there was first a simple reduction, then there was also a bond buyback program that resulted in a gross reduction of Greek public debt of about 128 billion euros. Then at the same time, there was a need to recapitalize the banking system and also to give incentives for investors to invest in new bonds. So therefore, the net reduction that you can observe between the end of 2011 and the end of 2012 is only about 50 billion. So whatever the attempt was to reduce gross public debt was severely reduced by the fact that there was now a need to recapitalize the banks. So a lot of the benefits, so to say, of the haircut had to be taken away, had to be given away by the need to recapitalize the banking system. And that obviously has bigger implications because in many countries, given that there is no limit on how much banks can invest in sovereign debt, there is always a question, what happens if indeed there is an over-indebtedness of public debt, of states? What happens if indeed a haircut should be taken? What would happen with the banking sector and therefore also the need potentially to recapitalize the banking sector? So therefore, it is potentially one of the crucial elements that may explain why are spreads too low, given the different risk levels that we would observe for European sovereign debt. Maybe taking into account by markets that indeed if there should ever be a real over-indebtedness in a country, maybe many countries would shy away from really doing the haircut and rather thinking about the potential consequences this may have on the banking sector. So therefore, financial stability is not guaranteed, and therefore bailout is in that sense the necessary consequence given the lack of financial stability. And now it's very important to think about what actually is happening here, because obviously when we think about government bonds, sovereign debt, then it's clearly the case that there are some genuine, or you could say natural advantages that those bonds enjoy. So the continuity of the state, the ability to tax, also the market size, so this means the liquidity that comes with it. But, and this is what I'd like to focus on, there are actually not only a few, but rather numerous ways in which laws, regulation, institutional design put a significant advantage on government debt. The one element that I already mentioned is maybe one of the most severe ones, that in contrast to all kinds of other borrowers, there is no borrowing limit that a bank would face when thinking about giving money to government, or you could also say local government borrowers. So therefore the big question is, how can one actually finally break this vicious circle? So how can one finally address the way, or this, you could say, the lack of financial stability that comes with this state bank nexus, and how can this be done in a way that it doesn't create too many trouble or too many problems right away, and also to avoid immediate negative consequences. So therefore, what I'd like to start with, just to give you an overview of what are the privileges, so the institutional regulatory privileges. And as I said, there are quite a few of them. So to start with, there are no capital charges that have to be taken against holdings of government debt in banks. And it's again different from any other holding. So this means if a bank gives a loan to a corporate, it has to analyze how risky is that corporate, and based on the riskiness of that corporate, a certain equity buffer has to be kept. This doesn't apply to states. So there is the possibility, the option that banks have, that they don't have to put any equity against the lending to corporate or to government borrowers. Next, which is also interesting from a regulatory perspective. So as a consequence of the financial crisis, the regulators thought we need to address 2 points. One is we need to induce banks to hold more equity. And second, we need to induce them to hold more liquidity. So making sure that there's no drying liquidity market that can take those banks out of the market. What regulators then discussed and thought about is the so-called liquidity coverage ratio. And this liquidity coverage ratio suggests that banks need to hold certain assets at all times to secure that they will not run out of liquidity. Now, the interesting aspect here is that, again, the incentive that is given to banks is to actually hold significant amounts of government debt. And this has to do with the types of assets that can be held by banks to meet the requirements of the liquidity coverage ratio. They are sort of, you could say, called level 1 assets and level 2 assets. Level 1 assets are those of which banks can hold unlimited amounts and in which there are no haircuts. And it might be no surprise that these assets are in particular sovereign debt instruments. And then there are all kinds of other assets, level 2 assets, which only can be held to a maximum share of 40% and to which also haircuts apply. So this means if a bank now faces a situation of how to best get the requirement done on the liquidity coverage ratio, a natural tendency would be to say we rather invest more in government debt and less into other instruments. Even though you may argue that some of the most liquid instruments, the securities out in Europe, might, for example, be corporate bonds. So if you have a large corporate bond issuer, those bonds might in fact be more liquid than maybe some of the smaller sovereign issuers. Next, this is what I mentioned, is the lack of a large exposure limit. As I said, normally a bank would not be allowed to give more than 25% of its equity to one borrower. This limit does not apply to governments. And I should say this as a side note, this discussion is not only a discussion, and I think this fits very well to Econpol, it's not only a discussion between, say, some of the more solid countries and the less solid countries when it comes to public finance. It's certainly also, for example, when you look at Germany, a major debate within the different levels. So, for example, if you look at the Länder, so the federal states, basically the central government, and even some cities that borrow, these limits also have very different implications for them and also lead to very different discussions. So, for example, if to make it very concrete, while the federal government of Germany might be probably not unwilling to think about a limit here, when I, for example, presented this to the city of Berlin, or you could say the federal state of Berlin, they would be not that happy actually about this limit to happen, just because they also use this as a rather cheap way of financing and circumventing the regulation that would apply to other borrowers. Maybe a couple of more thoughts, because these are just some of the privileges, but there are more of them. The next one, I think, is a very crucial one, and it's very crucial in particular for the development we've seen over the last years, which is the collateral that central banks accept for their open market operations. And here, the central banks, in the ECB in particular, has different liquidity categories for the collateral they accept. And it is that the highest category, category 1, requires the lowest haircuts. So this means if you have a security of level 1, the haircut is lower than, say, having a security of level 2, 3, and so on. And again, here, the requirement actually favors public debt, because all sovereign government debt securities are classified as category 1. So this means, for example, corporate bonds are just classified as category 3. So again, it would be an incentive, all else equal, for a bank to say, I rather invest in sovereign debt, given that it's easier for me to pledge it as collateral to the central bank, and thus to do the refinancing. On top of that, so this is something that is independent of the crisis. On top of that is the question of what happened during the crisis with the acceptance of collateral, in particular, again, of sovereign debt by the ECB. And here there were exceptions made to still accept certain collateral issued by governments that otherwise would have not been possible. So therefore, the widening of the collateral standards, or you could also say the easing by which different collateral could be used to finance banks, led to the fact that this part was very useful, very important for banks to, in fact, get additional liquidity from the central bank. Also, and I will come back to this, it's obviously a big question at a point of time when also the buyback programs of the ECB play an important role, or when the ECB puts additional liquidity into the market. So therefore, and this is the next point, the direct purchases and then also the, you could say the OMT, the quantitative easing, all deal with the question, with a preference by the ECB to buy these securities, significant amounts of these securities, bringing further benefits into them, in particular also reducing significantly the default probability of them. So therefore, bringing this together, these are already pretty significant advantages that are not driven by the genuine advantages that sovereign debt enjoys, but rather by regulatory decisions that are made to induce additional incentives for holding government debt. Then there is, maybe just as an add-on, there are a couple of more things which might not be, at first sight, may not look so important, but still are quite interesting. So for example, when you think of corporate bond issuers, they actually have to undergo very strict requirements, say, regarding transparency, ad hoc information, the accuracy, the honesty with which information is declared. And much of this does not apply, or does not apply fully to sovereign debt. So in that sense, it is there's no need to publish quarterly financial reports. There might not even be a need to reveal fully and truthfully whether there's an additional issuance going to come up. And then maybe some other parts which are probably more relevant at this point of time for the United States. It's also a question of whether taxation has different implications, or the lack of taxation is differentiated between corporate and sovereign debt. So therefore, again, showing there is a wide array of advantages that sovereign debt enjoys, and that may also help to explain why it's such a common instrument for banks and other financial institutions, insurance companies in particular, to invest into. So now the question is, what is the consequence, right? I mean, this is all just the groundwork. What are the consequences of that? And it is, first I'll start from say, an abstract level before I go really into the numbers. First of all, it's easy to imagine that if interest rates are lower than what they should be based on these privileges, then investment incentives for banks, for insurance companies, for other financial institutions might get distorted. It might also suggest to the public, so to say the federal state, that it's easy to expand public debt to actually spend more than actually what is really there. So therefore, relaxed budget constraints might be one effect. The other one might also be a crowding out, something that has been observed very crucially and also critically with respect to the buying programs of the central bank. So is it really that by having now a big central bank buying all these assets, that private investors are crowded out, so that they are, for the market, the functioning of the market is severely distorted? Here's now the empirical evidence, and I think this is it's very important to have a very careful look at that. So this is data that was revealed by the largest banks in the Eurozone in the stress test that the ECB or the European Banking Authority undertook. And I'd like to start actually in December 2011 and then take a walk through time. What you can see here is, and this is the figure that I refer to, these are the Greek banks. And as you can see, in December 2011, Greek banks held about 400% of their equity in Greek government debt. Also not to ignore, also German banks have a high investment into German government debt. This is at more than 450%. Here you see also Cyprus, 400%. And what is actually interesting here, and you probably can even make a story out of the financial crisis. In Cyprus, it is a little bit different from the other countries in the following way. When you see this light blue bar, this always relates to how much does a bank in a given country hold of the government debt of that country. So how much basically do Greek banks hold of Greek government debt? This is a light blue one, and you see in the Greek case, these banks hold above 350% of their equity in Greek government debt. In Cyprus, it's only, you could say, about 40%, while all the rest is in foreign government debt. So now this is mostly, as we know now, was mostly Greek government debt. So this means at the point of time where a haircut on Greek government debt takes place, it not only affects the banks in Greece, but it also affects the banks in Cyprus. This is where we started, and it's important to put this here, because this is before the decision was taken to start the banking union, right? The banking union, the major decision was taken in June 2012, and the explicit goal of the banking union was to say we want to break the sovereign bank nexus. So this means on the one hand we want to make it less likely that problems that arise in the banking sector also affect governments, but at the same time, and I think this is very important now to follow through time, we also would like to make it less likely that any problems that are arising in states may affect banks through the holdings of government debt. So now comes the development through time. So let's just look at the first period between 2011 and 2013. So this is basically exactly the period of time at which the banking union starts. And it's unfortunately the case that the goal of the banking union in this respect was not really achieved, but rather the contrary happened. So these are data taken from the Bundesbank in November 2013, and they say Italian banks over this period of 2 years increased their holdings of government debt by 73%. Spanish banks increased it by 81%, Irish banks by 60%, Portuguese banks by 51%. So what most likely happened? Most likely what happened is additional liquidity that was provided by the ECB was taken by banks to buy government debt and then use this government debt as collateral vis-a-vis the European Central Bank in open market operations and to increase liquidity there. What might be even more alarming is, this is a cross-section across countries. There's one additional element which was analyzed also in one study that looks at how actually is the distribution across banks. So not across countries, but across banks. And this study shows that the weakest banks, so those banks that have the weakest capitalization, were the most active in increasing their government bond exposure. So you could say when there's a criticism of the, say, European Systemic Risk Board of having overbanking, a situation of overbanking in Europe, then maybe those banks that did not really have a sustainable business model, that probably most likely should have left the market, were the most active ones in buying this government debt, because what they could always do is an arbitrage, or you could also say a carry trade between what they could earn on the sovereign debt issued by the countries and the interest rate, or you could say the lack of interest rate that was charged on them by the ECB. And given this arbitrage they could enjoy, that actually may have been one way to still keep these banks alive and boost their profits. So that is the situation between 2011 and 2013. And this is now are the more recent data, again for different countries, this increase also continues more recently. So it's also that in those years that follow, you see a steady increase in exposures that banks have to or versus their sovereign. So therefore, really a significant question because again, reminding us of the Greek case. If indeed a country is over indebted, then this situation would immediately lead to the fact that the flexibility of simply doing a haircut on sovereign debt is significantly limited. It is not simply possible to say we cut the sovereign debt, because we always have to take into account what is actually happening with the banks or the situation of those banks. Now, also just to give you a little bit more of recent data here, this also is important to keep in mind. As I said before, the regular tendency is for banks to actually completely concentrate their holdings in their own country, but there's also deviation or difference across countries. So some countries or banks in some countries diversify their holdings more than they do in other countries. And the combination of the two really is what is alarming. So this means if indeed there's a high exposure to sovereign debt plus a high concentration of that debt in their own government debt. So this means if there's a home bias combined with a vast volume of investment in sovereign debt that takes place. So now I'd like to discuss one current suggestion in particular, because it's has gained high importance just this week. I will come back to that. And then I would like to contrast this with a suggestion, as I said, that a co-author and myself have worked on, of what could be an alternative. And to maybe give a little bit of background on this, there will be, or there is currently a consultation process by the BIS, so the Bank of International Settlements, and also asking for suggestion of how really to deal with this question of how to deal with this challenge. And many suggestions probably will be handed in. Some obvious ones, or let's say seemingly obvious ones, have already faced criticism. So for example, if a very straightforward solution would be to simply say, we basically apply the same regulation that we have for corporate debt also for sovereign debt. So this means a bank is not allowed to give more than 25% of its equity to one sovereign borrower. And so far, nothing really has happened. So the discussions on the political level on this have not really led anywhere. And this most likely has to do with the fact that those who actually regulate or could regulate this process are the ones who would be could actually still benefit most from the current regime. So this means a finance minister who actually could say, I'd like to restrict the requirements, I would like to make it harder to invest, for banks to invest in sovereign debt, would be also the one who actually would face the consequences immediately by not finding particularly interested buyers for sovereign debt. And that's, I think, an inherent problem. In German, the proverb is, den Bock zum Gärtner machen. This is exactly what applies here. So this means that there's an inherent incentive, or you could say a conflict of interest in this regulation that is out there. So therefore, I would argue it's even more important for us, so as academics, to keep pointing to this very point, just to make sure, to make aware that there is such a significant challenge to tackle. So now, the one suggestion I'd like to discuss a little bit more in detail, because this is, as you will see, something that has gained a lot of attention, are the so-called sovereign bond-backed securities, or SBBS. And they have some interesting, and I also find good elements, but there are also, and this is what I will concentrate on, there are also some rather problematic, and I would say even significant risks involved with them. So the idea is like this, and this is basically, you can think of this as a balance sheet of an entity that is supposed to do the pooling and tranching of sovereign debt. So what would this institution do? On the left-hand side, so on the asset side, it would basically buy government debt of European countries. And now there are different ways in which this institution could do it. For example, it could be buying these securities based on the economic power, the GDP ratio of these countries, or, and that's actually already a very important question, or it could buy these securities based on the outstanding bond volume of different countries. So now the good element of this suggestion is that in fact it relates it to the ECB capital key, which in fact is, is highly dependent on the economic or the GDP by country. Because what else would happen if indeed this weighting was based on the outstanding bond volumes by country? That obviously would mean that countries that have a lot of bonds outstanding, so in relative to GDP, so say Italy, would then also get a benefit in the way that this institution that would have to be created could buy a larger share of those bonds than say of countries that have a lower debt to GDP ratio. So that's the left-hand side. What would happen on the right-hand side? On the right-hand side, there would be tranching. So this means new securities would be created based on different seniority levels. So there would be senior bonds, there would be mezzanine bonds, and there would be junior bonds. And then these securities would be sold to outside investors. The senior bonds in particular would then be calibrated in a way that their default probability would be going or would be acceptable for rating agencies to still enjoy a rating of say AAA, and the other ones would then obviously include lower ratings. So therefore this tranching is a very important element in there. The idea is in that sense to create, and this was the original name of this suggestion, to create so-called safe bonds, and the safe bonds would then represent the senior tranche of this. This suggestion first came out, according to my memory, in 2011, but it has gained quite some attraction among policymakers. And I'd just like to give you three statements that actually show how much the discussion takes place on these SBBS. And in particular, I'd like to mention the one that just came out earlier this week. So the high-level task force on safe assets by the European Systemic Risk Board. So you'd say the highest financial supervision authority in Europe. And this is a long document that came out with calibrations and so on, but the main conclusion is the one that I put here. The task force main finding is that a gradual development of a demand-led SBBS market might be feasible under certain conditions. So therefore, it's an endorsement to think further about the development of this asset and therefore to create suggestions of how it could be implemented. Maybe going a little bit more back in time and also to show you the relevance, maybe also for the discussion that will follow in the next couple of weeks or months. In the so-called Santa Claus package on December 6, 2017, the European Commission brought out the statement that the Commission is supportive of the development of European sovereign bond-backed securities, and what is now being discussed is a so-called enabling framework that shall be presented in the spring of 2018. So this means the discussions are going on, and soon there will be a presentation, or say a suggestion by the Commission to go that way. Maybe going even a little bit further back in time, in October last year, there was again a presentation, a suggestion by the European Commission to use this also in the, you could say, fulfillment of the banking union, to add additional elements to the banking union, and to include in that sense seemingly high quality assets as an additional element for European debt markets, sovereign debt markets. So now the question is how to assess these items, these assets. The first one is, and that's I think is in my view the crucial argument against them. When we go back to this, there's actually nothing that would prevent any private institution at this point of time from creating, pooling, tranching these securities. So it could be easily done, right? It's pooling, tranching is commonly known among private institutions. So they basically could just go ahead and create those assets. They would actually, each of us could in principle do this. So we could just buy a bunch of government debts, say according to the ECB capital key weights, and then basically tranche them and sell them to other investors. At this point of time, no one actually has really tried, or you could also say the demand for this type of security has not really been there. So it's not that there's a genuine market demand. And I think this demand, given that it's also so prominently displaced in the ESRB statement, is something we should really focus on. So this means so far no one actually has really done it. Then the question is, how could it actually work? And the suggestion includes a couple of hints of how it may actually work. So maybe just going back once more to this. One suggestion could be that for the senior tranche, now say the old privilege of government debt is used, while the existing privilege for existing government debt is taken away. So this means, in principle, while now a bank would hold the privilege of no capital charges for, say, German sovereign debt, this would then be reversed. So this means once this new element has been introduced, German sovereign debt does not enjoy anymore the regulatory privilege, and this regulatory privilege is transferred to the senior tranche, only the senior tranche. So therefore you could say maybe the creation of demand is only possible by changing the regulatory incentives. But that obviously raises a question, is this then really helping to fulfill the idea we had with the banking union and really to reduce the regulatory privileges that we observe? Now, this actually goes back to something Clemens mentioned in the beginning. As you know, Clemens and myself, we are part of the academic advisory board to the Ministry of Finance. So therefore, we sat together earlier this year with the Economic Advisory Council and looked at the suggestion, also wrote a letter to the minister, and we made a couple of points in which we criticized this instrument. What we in particular took as you could say, as a guiding theme of our letter of argumentation is to say we should rather address this problem at its root cause. So rather to think about taking away the privileges and not thinking about a reshifting of privileges from one instrument to another. The other one is certainly, as I mentioned, if there was market demand, anyone could create these instruments right now. And now come a couple of additional questions. So one is, what would happen if at some point the junior tranche should not find sufficient demand in the market? So this means if no investor was willing to buy this junior tranche, then the argument could be made, oh, there needs to be someone else who actually will buy it. You could always argue in that sense there is a seemingly or say perceived market failure, therefore some European institution would have to step in and to buy that security. So that is one risk. The other risk could be that there could be a perception that if indeed a public institution was to issue those instruments, that thinking of a public issuer, that there's no default risk. So therefore, it could give the wrong expectation to investors. It's a public institution that issues this instrument, and in fact, the expectation therefore is there is no default risk. So therefore, we came to the conclusion in this letter there are significant risks involved in the suggestion, that it may actually lead to what we call Eurobonds via the back door. So just because of the mechanism that is in place, that this may affect taxpayers across Europe. Now you may argue, and this is again, I think, relates very well to what Clemens said in the beginning. This is just a bunch of German economists. They have a very specific view on these things. But it's not the case. So I give you one more comment or one more assessment of that, which is from the Economic and Financial Subcommittee on EU Sovereign Debt Markets, which is a letter that was written in June 2017. And you see some of the criticism that we pointed out to also is pointed out by the committee. And they in particular are concerned about the market, the pricing, the liquidity of those markets. So for example, they say that in order for this market to become popular, it needs to be a big market, it needs to be a large market. But if it is indeed a large market, then it could have negative impact, so you could say negative externalities on prices, price formation, liquidity in the sovereign bond markets themselves. So therefore, it could actually become more expensive for certain countries to issue bonds. It might also include additional transaction costs, given, for example, that there's a high need for coordination between different countries. And it's also, and this is obviously very important for thinking about the different tranches, it requires a very good knowledge about the correlation of defaults of different countries. And therefore, the question is, can we actually give a proper assessment of the correlation at a given point of time? Wouldn't it rather be the case that, for example, the correlation becomes very high, becomes very strong at a point of time where a crisis really emerges? So this means correlation matrices might be completely fine for the time being, but once the crisis really emerges, what is then happening to that level of correlation? So therefore, the criticism is not just coming, as I said, just coming from a bunch of German economists, but rather it's a broader criticism that also comes out of a number of other aspects. So first of all, and this is quite interesting, it is strongly opposed also by Italy for the following reason. If indeed the key, this capital key of the ECB is the relevant key for deciding of how much can be bought by this institution, then if you have actually a ratio, a debt to GDP ratio, or you could also say that you have an outstanding sovereign debt volume that is in relative terms much higher than your relative economic strength, your relative GDP, then only a certain part, in Italy's case it's only 50%, only 50% of the outstanding debt can actually become subject to this pooling and tranching. But that means that the rest, the other 50%, rather face even more significant problems because they are viewed, you could say, as stigma types of assets. They are in that sense just second class in which no one would like to invest anymore. And so therefore, this has been an argument in that sense not only by debt managers in Germany, but also in Italy. And the second one is, this is a first assessment by the rating agency, one rating agency, Standard & Poor's, and they basically say tranching is not a way to create low-risk assets. What they rather are concerned about is that these sovereign bond-backed securities rather reduce the supply of highly rated assets. So therefore, we have now a very interesting situation in which market participants, public debt managers, rating agencies, also some academics, have a rather critical view on this suggestion. And nonetheless, as you could see from the ESRB statement, there's a strong endorsement for this to move forward and also to be part of the discussion on the European level. Now, therefore, given that obviously it's also an important part for academics not to just criticize, but actually to come up with solutions, suggestions of what actually could be done, my co-author Dietrich Mattes and myself actually thought about a rather simple way of dealing with this challenge. So how to actually induce banks to diversify their portfolios. And as I said, what I like about the sovereign bond-backed securities suggestion is to think about this ECB capital key. So this is the capital key. And as you can see, the capital of the ECB is held to, say, about a quarter by Germany, 20% by France, 17% of Italy, and so on. And what we like about this capital key is outside political discretion. So it's just given by the economic strengths of the various countries, and it's not driven by any, say, political trade. And what we would like to do in our suggestion is actually to induce or to give incentives to banks to start diversifying their portfolio according to the capital key. How would this work? So I'll basically briefly go through the mechanics of it, but it's basically just to say, give an incentive for banks to not keep all their eggs in one basket, but rather to diversify their portfolio. So let's say the bank decides to hold a total position of sovereign debt, and we call this capital S. So this is basically just a decision by the bank. Then we say, if the bank holds this total amount of S exactly according to the capital key of the ECB. So what we basically say is you can say for each country we multiply the total amount they hold by the capital key. So this means, for example, for Germany, if they keep 25% of what they want to hold in sovereign debt in German government bonds, it's fine. There's no capital charge to that. However, if the bank decides to hold more than what is given by this capital key, so this is what we call here C, which is the difference between what it holds and what it should be allowed to hold according to the capital key, then here the standard regulatory capital formulas apply. So this means this difference would have to be kept and would have to be buffered with equity. So this means, for example, if a German bank decides to hold 30% instead of 25%, then this difference would have to be buffered with additional equity. And then we would add a couple of more parts in particular. For example, if you have a small country, then it might be advisable to give a certain buffer to that country. So let's see if a bank in Malta was only allowed to hold a very tiny share of government debt coming from Malta, then it could still be possible to induce a certain buffer. Let's call it X, and this buffer would then, for example, say you can, of your own country, you can hold, say, 5 or 10 percentage points more than what the capital key suggests, just to make it also better usable for smaller countries. So what we basically think of this is here, that it is not a hard constraint, it's rather an incentive that is given to banks. And this incentive doesn't interfere with the actual security they design. So it doesn't interfere with the tranching and pooling of securities, but rather just gives an incentive to banks to actually diversify their portfolio of sovereign debt, and therefore to give an additional buffer if indeed there's a crisis in one given country. So therefore, to conclude, and then obviously I'm very happy to discuss this further, what we'd like to do with this suggestion is, in fact, focus on the right element of integration, diversification of portfolio investments. So really give incentives for diversifying portfolios and not keeping everything in one's home country's sovereign debt. Second, because this also has been an argument that has been repeatedly made by banks, that if all of a sudden all the sovereign debt that these banks hold needs to have underlying equity, then this actually would create a significant charge. It could be a quite significant adjustment process for these banks. So therefore we say it's not the total portfolio that needs to have underlying equity, rather only the differences from the capital key. I think the most important part from our point of view is there's no pooling or tranching, so it's really a very simple part. We don't need to create new securities with the involved challenges. And there's no risk of, say, any Eurobond via the backdoor, so there's no implicit problem arising from the fact that this is issued by a European institution, or there's a tranche that might not be sellable in the public markets. So therefore, we also believe it is something that still can exert market discipline on countries, while it also can buffer the adjustment process. So how could this adjustment process work? For example, by just simply saying, if, say, a German bank now holds 75% of its, or take an Italian bank, holds 75% of its sovereign debt in Italian sovereign debt, and the actual ratio should only be, say, 20%, then define a time path over 5 to 10 years over which this should be slightly adjusted, say in continuous proportional steps, be adjusted, so at some point to arrive at the outcome. So this, as in our view, rather simple, straightforward, but nonetheless consistent approach for market discipline and for reducing this overall dependence on sovereign debt, and therefore also to reduce this one challenge that we face to break the bank-state nexus. This so far from my side. Now, obviously, I'm very happy to engage in discussion, questions and answers. Thank you for your attention.